Okay, let's get going. It's 11 o'clock. So I'm joined this week by Andrew Mahatty, who's going to be running through what happened over April. And then I'm talking to Laura Foll of one of the managers of Lowland in replacement of the previously advertised guest. So a bit of news this week. So Aberforth's a bit of income. There's announcing what they're up to as we approach the end of that fund's life, and then Chrysalis announced a quarterly NAV. So Aberforth first. This is a fund. It's a split level fund. There aren't very many of them. It's traded very close to asset value for all of its life, as you can see here. It's not huge. It's a mix of ordinary shares and zeros, and the market cap of the ordinary shares is 155 million. It was launched in July 2017 as a rollover vehicle for a fund that was called Aberforth Geared Income. And the ordinaries and zeros were launched in a ratio of about 4:1. And because interest rates are that much lower then, the zeros were issued with a gross redemption yield of 3.5%. So basically, they accrue that all the way through the life of the fund, and then they get paid out the fixed capital amount at the end. They get paid in dividends or anything in the meantime. And the gearing that Zeros provides helps boost the income on the fund, which is obviously quite attractive if you're an ordinary shareholder. And it also gears the returns on the capital side too. So had it performed really well, it would have magnified that. It always had a planned winding up date of the 1st July 2024. And it's benchmarked against what is now the Deutschland US Smaller Companies Excluding Investment Companies Index. This is from the end of March fact sheet, so you can see where the fund was standing then. And unfortunately, in terms of both NAV and share price, it's underperformed the index, and that index has underperformed the all share. So obviously, we know the small caps underperformed. And I'll explain why in a second. I think the fund has underperformed. The total assets figure is probably a better measure of how it's done. That just gives you what the portfolio performance has been like, but it's still below, well, marginally, the US Small Companies Index. In terms of income, they started off targeting a 4p dividend, and they managed to achieve that. But they had to cut it during COVID because the income wasn't just coming in. But this year they're going to pay like a bumper dividend of about 6p. Some of that is coming from special dividends, and some of it's coming by paying out all the revenue reserve because things come to the end of its life. Small cap, we're going to talk about a lot more later on, but obviously it's been a difficult market since 2017. And actually, in terms of market cap, the universe has shrunk. It's always had a kind of value-driven approach, so looking for cheap stocks, and they tend to look at things in terms of EV/EBITDA, but the PE ratios give you quite a good indication of what's happened to valuations. So when they were launching the fund, it was trading at 13.5 times price earnings ratio, and they thought that was cheap, especially cheap relative to large cap stocks. But by the end of December 2023, that had gone down to 12.8. And because they're targeting cheap things, the P on the portfolio is only 8.9. So they target value stocks, and for a big chunk of that period, value was underperforming. But that all flipped in the beginning of 2022 when rates started to climb. So they should have had a better period anyway in the last couple of years. But the other problem that they've had is that they've had quite a big exposure to the smaller end of the small cap market, and over half of the portfolio. And that has dragged down returns. So larger companies have generally performed better than smaller ones. So anyway, so we get to the end of its life. What they're going to do, they're going to launch a new fund. So Aberforth Geared Value and Income Trust. Again, it's a split capital fund, so a mixture of ordinary shares and zero dividend preference shares, both of them issued at £1. We don't know what the redemption yield is going to be yet on the zeros. That will be revealed when they publish the prospectus, which will be around the end of May. I think this is really interesting because it's the first time anybody's had a real go at trying to raise some money since the end of 2021. They're not going gangbusters on this thing, so they're just looking to try and maintain the number of the sort of rough size of the assets they've got under management here. So the old fund was about £200 million. So they want to cap the size of the new trust around that level. So the new investors will only be able to get into to the extent that existing investors want to get out. So that's the first thing to remember. And also because they want to have a kind of fixed ratio between the ordinaries and the zero dividend preference shares. If too many people want one rather than the other one, they're going to have to be scaled back. But obviously, anybody who wants to can just opt to take cash out. And when this fund was launched, quite a lot of people moved out of the fund at that time. They're targeting 5p dividend for the first year, so down from this kind of 6p that they're paying this time round. Aberforth are making a sizable contribution to the costs, which is going to help get this away, I think. What we'll do is, when we've got a bit more information on exactly how it's going to work, we'll have a look again. I do think it's going to be interesting to see how this goes. It's a good sort of test of the sentiment in the market, really. Chrysalis next. As we know, this is still trading at an enormous discount, even though the NAV has been sort of slowly ticking up. And what Morningstar haven't picked up yet is the latest move in the NAV, which is what I want to talk about. So that's gone up by another 4p or 2.9%. And that's really driven by the valuations of the underlying portfolio, not helped by foreign exchange moving the wrong way. And so this just breaks that down company by company within the portfolio. And as you can see, the big jump here is in the valuation of Starling, which is the bank. But that's offset by a big fall in the value of WeFox, which is the insurance business. But they've got other compensating things too. So Smart Pensions up here, 22.1 million. Again, they've invested on £6 million in that. And the other big movers are Featurespace and InfoSum. What's fallen off the back here is Tactus. So this was a thing that was valued over 40 million. They wrote it down to 8 at the end of December. It now no longer appears in the list of investments. I think they might have written down to 0, but they didn't actually comment on that, which I think is quite strange, but there we go. But not everything's going to be a winner on these things. That's always going to be the way. So in terms of what's going on with those things and what's driving those things, Starling, especially since interest rates went up, has been consistently profitable. It helps that it's got huge cash balances, and it's earning money on those now in a way that it wasn't earning money before. And it's also been able to cash in on the value of the software that underpins how the bank runs. So they've sold that to a Romanian bank and to AMP in Australia. And they're looking to do more of those sorts of deals. So that's actually quite encouraging. And then the other one that is good news is Klarna. I've talked about this in an article last week, actually. So basically, there's a story around them using AI to replace call center jobs, and that's saying that's saving them £40 million a year, which is a big chunk through to their bottom line. So that's obviously very good news. WeFox going down, although it doesn't look great, is not all about what's going on in the business. A lot of it is down to the fall in the listed comparators. So that doesn't really, crystallize anything. They did reposition the business though, so they stopped this idea that they were going to write their own insurance, and they're just focusing now on the normal kind of business that they've got. We'll see what happens with that, but it was quite a big write down. Smart Pension is just going great guns. The reason they had to put more money into that is just because of the growth. It's growing so fast. And so £1 billion a year of inflows is something that most people kill for. InfoSum, they didn't really explain why that went up, but I think it was largely because as a peer acquired quite a high revenue multiple, so that might have had the valuation. And there's an unnamed sale. So remember, there was a bit of excitement at the end of last year that they said that they had something in the works that was going to add to the NAV, and then they wrote the NAV up. Everybody sort of commented around the market that's Core. So that would be really quite good news if they managed to sell that because it sort of free up some cash. So generally the mood is upbeat here, and that seems quite at odds with where the discount is, sort of 49%. So I'm going to now hand over to Andrew.
Terrific. Thank you very much indeed, James. It's such an interesting one, Chrysalis, and certainly there's a lot of potential in that one. We'll see how that plays out. As usual, I'm going to talk about what's been moving this month, and I'll also be focusing on discounts and exactly how those have been moving, because I think that's quite interesting at this point in the market cycle. So here we are. These are the major rises over the month. No surprise at all to see Hypnosis Stocks Fund at the top because of its bids, of course. And I think below that, the trend I think that has struck me is that some of the really out of favor trusts that have either encountered difficulties or been marked down because of skepticism about NAVs have started to recover a little bit. So we're seeing some of the more speculative ideas, I think, just coming off their worst levels. I can't say they're in demand, but they're off their worst levels. So we've seen, for example, two of the three battery storage trusts did a bit better this month: Gresham House Energy Storage and Harmony Energy. And that's because they have reassured the market that the revenues are starting to improve in that sector. I think as well, it's notable here that we have Seraphim Space, which is a bit of a poster child for the growth sector, and that's had some demand for its shares come back. Schiehallion Fund, which is always volatile. So there's quite a lot of interesting trusts here, I think, on the move during what was generally a reasonable month for investment trusts. But I think whereas there was quite a lot of excitement in the FTSE 100 going to new highs, we didn't really see that replicated across the investment trust sector, where the gains were generally a bit more muted. But we didn't see many things going down. And I think, again, that was quite encouraging that although the gains were not necessarily huge on the upside overall, there were many more risers than fallers. So not many fallers. The one at the top had a very specific constrained issue, JP Morgan Emerging EMEA Securities, where it was named as a defendant in a Russian court case, which has really nothing to do with this trust, but it's got caught up in the crossfire there. And it does mean, actually, that the massive premium on which its Russian assets were rated has come down. Other than that, there's not too much to report here. We've seen some falls from some of the highly rated trusts with a lot of US tech exposure, because that's just come off the boil a little bit. So Manchester and London and Scottish Mortgage are on this list. But actually, these are relatively small price changes over the month. Partly because of that, I decided I'd focus on the discounts, and the market ratings. And I had a look through the list of Z-scores. Now, if you're not familiar with Z-scores, that's a statistical measure of how much the current discount is diverging from its average over a certain period. In this case, these are 1-year Z-scores. And when I was looking down the list, I found that there were 4 sectors that looked a little bit cheaper now than they have been, and 2 that were more expensive. So I'll just talk through those quite quickly now. The first sector where some trusts are trading on much wider discounts than they have been over the last 12 months is real estate. And that's no enormous surprise because, of course, this is a depressed sector, highly sensitive to interest rates. And I think as some degree of skepticism has arisen over the room that central banks are going to have for early maneuvering on cutting interest rates this year, so some of the discounts have widened in real estate. On the left here, we have the names of 4 trusts that I've picked out, but on the right-hand side, I'll just explain the format of the chart here, that it's color matched to, so we're AEW UK REIT here in gray, is the gray one in the chart. So the colored bars are the current discounts and the black bars are the 12-month averages. And I think what's interesting here is that you can see these discounts are wider. AEW, I think, is a very strong trust. It has a really excellent track record, top of the sector over most periods. And its discount has widened out to 14.5% compared to its 9.5% average over the last 12 months. Life Sciences REIT is on a very big discount, just over 50% there, 51.7. And that's partly, I think, because of some disappointments at the pace of lettings there. But again, I think that's quite interesting with the average discount at 30. So you know, that's certainly offering some value if you believe they can pick up the pace of lettings and really sort out their revenues there. The next one I think is really interesting, Real Estate Credit Investments. This is an income trust that actually has a pretty flawless record, which is quite impressive given that it's investing in real estate debt. And it's offering a very attractive yield on a wider discount than it normally is at the present time. And the last one with the absolutely massive discount is Phoenix Spree Deutschland, discount actually approaching 70%. Which is a peculiarity. And again, I think there's been some disappointment here that the trust hasn't cracked on at a rather faster pace with the apartment sales that it was promising. So we'll have to see if it can raise any extra value there and get that discount coming in a little bit. So I think there's still opportunities in real estate if you're feeling reasonably sanguine about what's going to happen to interest rates for the rest of the year. In renewable energy, I think there are still some opportunities here. This sector, again, interest rate sensitive and has been, you know, it's come well off its peak levels, of course, and been out of favor for quite some time. I still think there are some opportunities here, but so you have to obviously look at the trust on a case-by-case basis. Here, I think Octopus Renewals Infrastructure, which is on a 31 discount compared to its average of 18, that has had some disappointments in its revenues, actually. And so, I think you'd need to look quite carefully at that trust. As well, it does have higher debt than average, which at the moment is a black mark. So typically there are reasons for these wide discounts, but you have to gauge, of course, whether that really justifies them widening out quite to the extent they have. The other one on this slide, Gore Street Energy Storage Fund, I sense that this one's rather hard done by, actually, because the other two trusts in the sector, which have really been the ones that have suffered from the fall in the UK revenues from batteries, they both come out with statements suggesting that actually things are improving and their share prices have reacted. Gore Street hasn't done that because it actually doesn't really need to, because it doesn't have so much UK exposure. But its shares went down this month, and I think that's possibly creating a little bit of an anomaly here. The discount now is 45% compared to an average of 28.9 over the last 12 months. So in my opinion, that could be one to take a look at. The third sector I noticed is growth. And this maybe isn't really a surprise. Again, I think investors are wrestling with the temptation to buy back into growth at this point after some time out of the market, possibly. But clearly, as regards timing, it's not easy. And again, you've got to judge each trust on its own merits. Impax Environmental, I think, is interesting. This is not always regarded as a growth trust, but I met the manager recently, and he was absolutely adamant that it's all about growth, this trust. It's not about producing income. It's really about finding good growth companies in that environmental space. And I think this trust is really the leader in the sector there. And for quite a long time, it was very highly rated, actually, as a result. And I think maybe just as green issues have slipped off the agenda slightly as we've been focusing on other geopolitical matters and also interest rates, perhaps this trust is now just sliding under the radar a touch, and you can buy it on a 12 discount compared to its average of 7.5. RTW Biotech Opportunities, that's another trust I like. This one, I think, has again just slipped off because it's perhaps digesting its recent acquisition of Arix Bioscience, and it's working its way through that. And also its largest holding, Rocket Pharma, has been a little bit weak in the US over the last few weeks. I follow that one closely. So again, the discounts just edged out to 33% compared to an average of 26. And the last one on this slide, Baillie, Gifford, Shin, Nippon. This would be a bolder choice, this one, because its recent track record is really quite awful. I mean, I was wondering which word I should use there. That's clearly because of its growth bias in Japan, which has not been paying off for a while. But actually, I think if you look further back at its track record, it really was exceptional for a number of years. So if we do see growth companies coming back into favor, we could see a recovery here. And again, you're getting a chance to buy in on a 16 discount here, which is a bit wider than it has been, and certainly far wider than it was in past years. So if you're a contrarian investor, I think that's of interest. The last of the four cheap sectors now, emerging markets. I don't think these are spectacularly cheap, actually, and you'll see that the difference in the bars on the right-hand side is perhaps not as stark, but nevertheless, they are trading below their average multiples over the last 12 months. Scottish Oriental smaller companies, decent track record there, and actually 17 discount, which I think is quite wide compared to where it's been in the past, not just over the last year, but before that. Templeton emerging markets. In my experience, this trust does tend to run a little bit hot and cold, and it tends to be either at the top of the performance tables or the bottom. At the moment, I think it's actually neither, but nevertheless, I think it's a trust that many emerging markets investors would still turn to, and it's on a 15 discount at the present time. And I think it's worth considering these global emerging markets trusts if you're reading about India or Vietnam or other exciting individual markets. I think it's important to bear in mind that those single markets really do come with a lot of added risk. And so actually having a diversified approach can pay off, in my view. Pacific Assets Trust is the third one on the list here. That's actually been quite highly rated, that trust. It had a very good performance period, and it's just slipped back into a double-digit discount. So those are the cheap ones, and there's two sectors that I think are a bit more expensive now compared to where they've been over the last year. The first one, probably no surprise, technology. There's clearly a great deal of enthusiasm at the present time about US tech in particular, and stocks like NVIDIA and the Magnificent Seven. And the two trusts that are most obviously exposed to that are PolarCap Technology and Allianz Technology. I consider those two as twins, really. Their track records are very close indeed, and their rating tends to be very close. And they both come in, they're both on single-digit discounts now, 8 or 9%, compared to more like 12 over the last year. So they come in a bit. That does worry me slightly, because I think there's a fair bit of chat in the media at the present time about the high rating of US markets and about the possibility of a correction over the summer if these much anticipated cuts in interest rates don't really come through at the speed we're hoping. So I think I'd be slightly wary there. And the third trust in the table here is Herald, where again the discounts come into 11 compared to 14 over the last year. And historically, it had been wider than that as well. In this case, there's the additional factor that Herald was one of the trusts where Saba took a stake, and that, of course, enlivens matters somewhat. So I'll move on to the very last sector here that I'm going to talk about. And this maybe was one I didn't really anticipate so much, and this is the global sector. So some of the big international generalists have seen their discounts come in. Really moving from typically slight double-digit discounts to modest single-digit ones. Not a huge movement, but nevertheless, I think it's notable across this sector. And there are a couple of trusts that are definitely trading at higher multiples than they have been, higher ratings, I mean. So Allianz Trust on a discount of just 2% compared to an average of 6% over the last year. That looks justified by its recent track record, actually, which is very good. And I think their multi-manager approach seems to be working quite well. They're just making a change, actually, there, swapping out Ben Whitmore at Jupiter because he's setting up his own boutique. And I was just thinking about that and thinking, actually, that when Allianz Trust decides to change a manager, it's quite a seamless thing, and they can do it quite rapidly without any major upheavals for shareholders. Whereas, of course, if you're a normal traditional investment trust with a single manager, that's a much bigger deal. So I think at the moment, the multi-manager system is sitting quite comfortably in this sector. And also, otherwise, I think perhaps investors are just buying back into these major trusts because they're feeling a little bit better about global stock markets, but they're perhaps still somewhat skeptical about the NAVs in the alternative asset space, and that's not really something that applies here. Typically as well, these trusts are more exposed to large caps, and maybe that's where investors are wanting to come back and get some additional exposure now. That's maybe why these discounts have narrowed. We'll never quite know. But anyway, I think at the moment in this market, there are still quite a lot of very attractive discount opportunities for investors. And there's quite a lot of movement in these discounts at the present time, which was really the point of me talking about it today. So as always, very important to do your research and check all your figures. That's it from me, James. Thank you very much.
Good. Thank you, Andrew. There was one question there from Tim Vernon saying, do we know why Gore fell and Harmony and Gresham rose?
I think specifically, no, but I think it probably was just the market reacting to those two positive statements, actually, from both Gresham and Harmony, whereas Gore didn't put out a statement that I'm aware of. And so it could just be that. And the trusts are quite distinct because Gore obviously has a lot of overseas exposure that the other two don't have. So they are quite different.
Cool, thank you. And there was actually a question earlier on about splits and how they work. And I think what I'll do is I'll send the person who asked it something, but actually I'll talk about it more when we get that prospectus from Aberforth, and I'll explain in some detail how it all works. Good.